proud to introduce to you a board member of Endeavor and one of the biggest advocates for Endeavor around the globe, Beim.
Thank you, guys. I don't know if anyone else out on the porch can hear, but I'll try to speak loudly. Probably best to start just by thanking our Brazilian host for a fantastic ISP here in Rio. This is my first time in Rio. I've fallen in love with the place. I'll definitely be back, and I think we should have more ISPs here in the future. So thank you to Endeavor Brazil. I also wanted to just thank all of the first-time entrepreneurs who have traveled from around the world to come here. I know you've put a lot of work into preparing for your selection panels, and I know it can be a little bit daunting to get grilled on your business by business leaders from Brazil, from Latin America, from all over the world, who ask you every conceivable question you can think of about your business, and maybe some that you couldn't have. I think it's worth remembering that the reason all of those people come here is that they're inspired by people like you, people who have risked everything to start their own business despite a lack of resources, people who represent much of the future economic development of their country. So thank you for coming and for continuing to inspire all of us. So a little bit of background. So my name is Beim. I'm a venture capitalist. I'm a partner at a US venture capital firm called Matrix Partners. Matrix is one of the oldest venture capital firms in the United States. We got started in the mid-1970s and invested in companies like Apple and Federal Express way back when. I say we in a broad sense. When we made the Apple investment, I was 3, although I was very much in favor of it. Unfortunately, it did very well. I've been involved with Endeavor for quite a long time, and I've been working with Quinn on this venture capital program, which, as you know, is designed to help entrepreneurs meet new investors, raise money, and understand how to best present themselves to investors. So in the spirit of this program, I thought it would be helpful, and Quinn thought it would be helpful, just to talk a little bit about the investor's perspective. What are those people on the other side of the table thinking, and what's most important to them? Some of you may not have to raise capital. Some of you may choose to raise debt rather than equity. Some of you may raise equity capital from friends and family, from venture capital firms, from private equity. There are a lot of different types of fundraising strategies that you may pursue, but I think a number of common principles underlie an approach to all of them. And I guess the first piece of advice that I would start off with is to think of your relationship with a potential new investor as a marriage. But it's even more than a marriage because you can't undo it. You cannot divorce your venture capitalist. You can't divorce your private equity investor. You need to make sure it's the right person. And they need to make sure of the same thing, that it's the right person. And like any great marriage, what's most important in that relationship is trust. And when presenting a business plan, and this I think came out in a number of the selection panel discussions, you give investors a lot of confidence when you're very open with them. Open about things that are going right, things that are going wrong, things that you understand, things that you don't understand. If ever an entrepreneur were to say to me, you know, I actually have all the answers and here they are, and there really is no problem with our business, it's pretty much a sure thing, I start to feel very nervous. I think, uh-oh, this person there's a problem, and they're not telling me about it, and more importantly, they probably won't tell me about other things that is going on with their business. So I think all investors are comforted, and this is a little bit counterintuitive, but it's human nature, are comforted by people who are just very open. And there's a frequent saying in the venture capital world, it's always better to invest in people who know what they don't know. Nobody knows everything, and many of the best entrepreneurs are young, and particularly when you're young and this may be your first business that you're working in or your second business, you don't have all the answers. That's okay. Investors aren't expecting you to have all the answers. What they're expecting is someone who has very high potential and someone who will reach out for help to investors, for other team members, to other board members, for that sort of advice. So very important is trust. And if you're fortunate enough to have a competition to invest in your company, and I'm sure many of you will, think about who you want to have as a partner as the most important criterion. I think an easy trap to fall into as an entrepreneur is to think about valuation. The founder of Matrix, who was an Italian immigrant to the United States, has been exceptionally successful for 3 decades, once had two slides on how entrepreneurs see the fundraising process and how investors see the fundraising process. And on the first slide, how the entrepreneurs see the investing process, there was one big word in huge letters that says valuation, and then in small letters, everything else. And then for the investors, it was reversed. Valuation is very important, but I think the most important thing to focus on is who do you want to be in business with, who do you trust most, who do you think can add the most value to your business. And maybe what I'll do is I'll run through, I know there'll probably be some questions, maybe just 10, 15 minutes of thoughts, and then we can open it up to Q&A. What are some of the other things that investors look for? They look for big markets, and this is very important. Big markets, by the way, can start with small products. But I think if you get a great team of people working on a difficult problem and they solve it and they create a successful business, the size of the win in the big market versus a small market is very significant. So one thing that investors look for is big markets. If you will work for 10 years, do an exceptional job and create a business that's just doing a few $1 million in revenue, it will probably be hard to attract investors. I think everyone here is of a very high caliber and has a lot of potential. So when you're thinking about your next business, your current business, think big, aim high, go for the big markets. You don't have to conquer them all at once, but one step at a time, figure out a way that you can get to a win in a big market. Second thing that investors look for is great management. Now, great management is never present, or rarely present fully at the start. You have to hire people as you go along, and what's most important, as I said before, is that entrepreneurs know where they need help. They know what kind of people they need on their management team to be successful. It is another saying in the venture capital world that the best teams win, and it is almost always true. And there are many cases of first movers, second movers, third movers getting off to a big head start, and then a great team coming up and cleaning up the market. Google was one example of this. There are many others. So. Investors look for a great team, and when you're raising money, they're looking really for the commitment to hire a great team. Again, nobody has all the answers, but if you say to them, I want to build the best possible management team for my company, that's something that will be very comforting to them. So another thing they look for is great teams. A third thing they look for, and this can be a little bit uncomfortable sometimes as an entrepreneur, but it's useful to understand an investor's perspective on, is good governance. Many of the best companies in the world were started very informally, in a living room, in a garage. I met at this selection panel my first company that was started in a bathroom, but companies are started in a variety of places. They're informal. Sometimes you started with your girlfriend, your brother, your spouse. They start informally, but I think every good company needs to evolve to a place where they can get to an independent board. And when you are a founder and CEO who owns most of a company, that's not always a welcome thought. You kind of think, well, this is my kingdom, and I'd like to stay in control. And all this independent board talk doesn't sound like it's going to keep me in my monarchic position. But I think it's everybody can always learn from others, and it's always good for a CEO, a founder, to be accountable to someone. You don't have to get there on day one. You don't have to get there in year one. But I think it's good to get yourself to a place where you have an independent board. If investors hear that you have a commitment to that, that will be very important to them. A couple other things that investors look for. They look for some distinctive advantage, some reason that you're going to win in this market more than others. There were a few companies that presented at this ISP where the founders had come out of companies that had particular, and they had, as a result of that experience, had particular insights into a problem in an industry, and a problem that many others may not understand. That's a special insight. That's a competitive advantage. Perhaps you have a skill set that very few other people in the world have. You're one of the experts in dental X-ray imagery. You can start a company around that. It's difficult to compete with you. It's something of an unfair advantage. You can't always get an extreme unfair advantage, but any advantage that you can get is very interesting for investors to understand. Sometimes the advantage comes from the complexity of the product or the nature of the relationships that you have as a company. But that's another thing that's very important to investors. Last two things that are very important to investors are, one, an ability to grow quickly. So for equity investors, the one variable that most closely parallels how much money they'll make is how quickly you grow. And so they'll want to see some credible plan to show you growing quickly. And if you just show projections that grow very high, that don't have a lot of thought behind it, that won't do the trick. Investors will see hockey stick projections, they'll look right through them, and you'll probably lose some credibility for those.